company has been in operation. Any question? Any question? Because I heard some bank over there. Is there any question? All right, let me continue. So the Companies Act 2019, Act 992, enjoins companies that are listed on the stock exchange to have their accounts audited by a qualified auditor. And if the company has been existing for more than 3 months without an auditor, the registrar of company can appoint auditor for the company and also make sure that the requirements that is enshrined in the Companies Act have been complied with. So all that I'm summing up is that the main purpose of auditing today is not about the detection of fraud and irregularities, but the auditor examining the financial statement to satisfy himself or herself that the underlying records that management used in the preparation of the financial statement portray the truth and fairness of the state of affairs of the entity. What then is auditing? When we say auditing, it is not something that you do today and that is the end. We say that auditing is a process. Throughout the whole year, that process goes on. Before the auditor is appointed, during appointment, and even during the retirement or the removal of the auditor, activity goes on. So auditing, we say, is a process which is carried out by a qualified person or body of persons whose responsibility is to examine the records and financial statements of businesses and give a report thereof. And the report thereof is the opinion that the auditor will give as to whether on the face of the records available, the financial statement so prepared portrays the truth and fair of the state of affairs of the entity. So auditing is a process, and that process is carried out by an appointed qualified person. You see, the emphasis as you have in the Companies Act says that there are a category of persons who are qualified to be called auditors. Pretty shortly, we will be looking at some of the criteria that makes a person or a body of persons qualified to be called auditors. We can also define auditing to be where an independent person, when I say independent person, that person is not part of the business that is going to audit, whereby that independent person examine the evidence from the financial statements and prepare to give an opinion always as to the truth and fairness of the state of affairs which they disclose in their opinion. One thing that you have to bear in mind is that the essence of auditing is to gather sufficient appropriate audit evidence, is to gather sufficient appropriate audit evidence. The opinion of the auditor is not given in a vacuum. The opinion of the auditor is not given in a vacuum. In the course of the audit, the auditor documents whatever information that comes to his or her attention. And in the end, the auditor will weigh the adequacy and sufficiency of the evidence so gathered and see whether they are of evidential value. And that will inform the kind of opinion that the auditor will give about the financial statements that management has prepared. It is instructive to note that it is the responsibility of management to prepare the financial statement. It is never the duty of auditors to prepare the financial statement. Auditors cannot be players and referee at the same time. There is a separation of duties. Management prepare the financial statement. Auditors come in as an independent person to examine the financial statement that management have prepared and give opinion thereof as to whether management has used the resources that has been entrusted into their care judiciously. So these are definitions as you find, these are terms as you find in the definitions. We're saying that auditors are independent or do independent examination. What? Yeah, is there a question?
Yes, sir. This is Bernard Oshiwato from SG.
Yes.
Per your explanation, is it possible that we have internal auditors at our various institutions? Since auditors are not involved in day-to-day activities, is it possible that we have internal auditors? That's my
Oh,
question.
businesses, yes. Companies have internal auditors, but internal auditors are employees of the company. The auditors that I am talking about here are external auditors, not internal auditors. They are external auditors. That is why we use the word independent persons. So they are outside the entity. They are a firm of auditors that are normally employed to examine the financial statements that management has prepared. It is never the intent, the work of the internal auditors to examine the financial statement. Yes, the internal auditors are there to make sure that the internal control systems that management has put in place are working. But to certify the veracity of the financial statement that have been prepared, you need somebody outside the organization who is independent to be able to certify that indeed management has used the resources that has been entrusted into their care. Are you okay with that?
Thank you, sir. Thank you, sir.
Very, very. So, what you say independent examination, it means that person who is going to examine the financial statement is not part of the business in question. It's coming from outside. Yes, any question?
Yes, sir. Yeah, please, let's say if an external auditor is coming from Accra to audit someone, let's say in Takwa, but happens to know someone within the organization, does that contribute to conflict of interest since that person is
Don't
coming
worry,
to audit
don't
that
worry
person's
yourself.
department?
Just don't worry yourself. Hold your question. You will be answered. I get it.
Okay.
Aha, you will be answered. This is part of the requirements of the Companies Act of 2019, Act 992. So just hold your breath. All right. So somebody from outside of the entity will be employed to examine the financial statements and give a report thereof. So the person who is coming from outside to examine the financial statement should be suitably qualified person. It means that it is not everybody who can be an auditor. It is not everybody who can be an auditor. So suitably qualified person, we are talking about the auditor being professionally qualified, have the relevant skills, experience, and integrity to carry out the examination. And what examination is that person going to carry out? He's going to examine the records and financial statements that management has prepared. The records and the financial statements are so many: books of prime entry, the ledgers, the trial balance, the income statement, statement of financial position, the cash flow statement, notes to the account, value added statement, director's report, a whole lot of them that the suitably qualified person will have to examine and also report on them to those who provided the resources that we call the shareholders. After they have examined the records and the financial statement, then they give opinion, and that opinion will satisfy whether the financial statement is truth and is true and fair on the face of the records that is made available to the auditor. Truth implies that the information is factual and conforms to reality. Fair means that the information is free from discrimination and bias. That is what the auditor will use to form his or her opinion. That is what you see here. True and fair means that the financial statements are free from material misstatements, and that, in the opinion of the auditor, proper books have been kept. The financial statements are consistent with the underlying records, and also the financial statements have been prepared according to the acceptable accounting standards and other enactments that the companies were obliged to adhere to. Why auditing at all? Why auditing? Why auditing at all? The need for auditing. Now, if you are a manager and shareholders have entrusted their resources into your care, periodically, you have to account to the owners or the shareholders who provided the funds for you to manage the business for them. Now, at the end of the period, the owners will want to find out and assure themselves that the report, for that matter, the financial statements that management has prepared contains no errors, and that the report is not misleading, and that the report discloses all relevant information. That is why they call somebody from outside the organization to examine the financial statement for and on behalf of the shareholders, so that the shareholders can satisfy themselves that whatever management is given to them is the actual report and is not misleading, which will not allow them to make an informed decision as to whether to continue having their money in the business or not. Objective of an audit of financial statement. Why do we audit financial statements? Why do we audit financial statements? Earlier on, I told you that we audit financial statements so as to enable the auditor to express an opinion whether the financial statement that they have audited in all material respects and in accordance with applicable financial reporting framework shows true and fair view of the state of affairs of the entity. So the objective of an audit of financial statement is to enable the auditor to express an opinion whether the financial statements are prepared and in all material respects according to the applicable financial reporting framework. That is the objective of an audit of financial statements. Conduct of an audit of financial statement. Conduct of an audit of financial statement. Now, when the auditor is conducting the auditor will have to follow religiously what provisions that has been made in the international standards on auditing, the ISAs, International Standards on Auditing. So the auditor is conducting the audit, not using his own means or information, but conducting them in consonance with the provisions of the international standards on auditing. Because the international standards on auditing contain some basic principles and procedures, and other guidance which will help the auditor to be able to execute the work that he has been employed to do. So the auditor will examine the work to do vis-a-vis the basic principles, procedures, and guidance that is contained in the international standards on auditing, so that they can do a diligent work for and on behalf of their client. For and on behalf of their client. What is the scope of an audit of financial statement? What is the scope of an audit of financial statements? Now, when you say the scope, we are talking about the audit procedures that, in the opinion of the auditor, are deemed appropriate to be executed to enable the auditor to be able to achieve the audit objective. So the procedures that, in the judgment or opinion of the auditor, are deemed appropriate so that it will help the auditor to be able to achieve the objective of the audit. And if the auditor wants to determine the audit procedures, then such audit procedures must be the same thing that is prescribed within the international standards on auditing. The auditor cannot draw up his or her own audit procedures. Any audit procedure that the auditor puts in place should be in accordance with the international standards on auditing. Because I have told you that the international standards on auditing serves as the main aid memoir for the auditor. And that will give blueprints, guidelines to the auditor as to how far the auditor can go in the course of the audit. The standard also says that when the auditor is performing his or her duty, the auditor must perform it with a professional skepticism. With a professional skepticism. When we say a professional skepticism, the auditor must have an attitude of a questioning mind, The auditor should be able to make a critical assessment with a questioning mind of the validity of the evidence that has been obtained. So it is not everything that the auditors see, as I've told you earlier, is of evidential value. So he has to be very skeptical in using information to form his or her opinion. The auditor will have to make sure that when financial statements are prepared, there is the likelihood that material misstatement or errors may occur. So whenever the auditor is auditing the financial statement, the auditor must have that notion at the back of his mind or her mind and examine the financial statement critically. That's what he says. He makes a critical assessment and with a questioning mind of the validity of the audit evidence that he has obtained, and be very alert so that he can unearth any error or misstatement that has occurred in the course of putting together the financial statements. Reasonable assurance. You see, when auditors audit the financial statements, they cannot examine 100% of all the records. The auditor cannot examine 100% of all the records. So what the auditor will do is to sample some of the records and examine it, and then his opinion is expressed to cover all actions that has taken place within the organization. One thing that we have to bear in mind is that in the planning stage of the audit, the auditor will have to examine the internal control systems that management has put in place. If the auditor examines the internal control systems that management has put in place and sees that they are working, it will reduce the amount of substantive testing and analytical procedures. Substantive testing, we call test of details, and analytical procedure, that is showing relationship among the items on the financial statement. If the auditor satisfies himself that proper things are being done within the organization, it will reduce the amount of tests that the auditor will do. But if, after examining the internal control systems, the auditor sees that things are not done properly, then the auditor will increase the amount of tests that he has to do so as to be able to gather sufficient and appropriate audit evidence. And after the work, the opinion that the auditor will give cannot be absolute assurance. When you say absolute assurance, it means that the auditor will give 100% assurance, but no audit will give 100% assurance, because there are some risks which are inherent in the nature of the business and the complexity of the transactions that the auditor may not be able to uncover. So the opinion that the auditor will give may not be 100%. So auditors only give reasonable assurance, but not absolute assurance. I usually tell my students that if we say the auditor can give absolute assurance, then the auditor is carrying the work in the world of utopia. In the world of utopia. U-T-O-P-I-A. It's not Ethiopia. In the world of utopia. That is the world of perfectionists. And that is never a reality. So auditors do not give absolute assurance, but rather they give what we term as a reasonable assurance. Reasonable assurance. So you see absolute assurance here. And listen to what this slide is saying. Very instructive. An auditor cannot obtain absolute assurance because there are inherent limitations in an audit that affect the auditor's ability to detect material misstatement. So it is not everything that the auditor can detect in the course of the audit. So they cannot give absolute assurance. And these are limitations. And these limitations may come from the use of testing, how the auditors tested the information available, the inherent limitations of internal controls, even the fact that most audit evidence is pervasive rather than conclusive. So all these things may not allow the auditor to stick out his or her neck and say that I can give 100% assurance that no error or material misstatement has occurred. Never. But they give a reasonable assurance. Reasonable assurance. Please, are you following at all? Are you there?
Yes, sir. Yes, sir. We are there.
Yes.
Yes, yes, we are. Yes, sir.
Very good.
Yes, sir. We are very here. We are very here.
Okay. Okay. At times, people log in and they go and cook. The ladies, they go and cook and they just log in. I will also take attendance. Yes. When I
Sorry, are
close, I will
you?
take. When I close, I'll call again. I will take attendance. So don't run
We
away.
are all here, sir. We are all here.
Yo, no problem. Now we have audit risks and materiality. I'm very happy that you are in level 400. At least you have done financial reporting 1 and financial reporting 2. So you know materiality. Materiality. An item is material if its omission or misstatement will make the financial statement look different had that omission or misstatement not occurred. So whenever auditors are auditing financial statements, there's the likelihood that material misstatements may occur or some risks may occur. So it is the responsibility of management to make sure that they respond and identify risks that will make the financial statement look different had those risks not occurred. But normally, these risks, we cannot eliminate all of them because some of these risks, by the nature of the business, are inherent. When I say inherent, they go with the business that they cannot be eliminated. So what the auditor will have to do is that the auditor will only have to follow procedures to make sure that these risks, even if they occur, will not have the tendency of materially affecting the financial statement so prepared. That is why literature tells us that these audit risks, some of them can be diversified, I mean eliminated, and some of them cannot be eliminated. So when we go forward, you will see that these audit risks is the risk that management and the auditor will not be able to detect that such risks are inherent in the financial statements that they have prepared. All that they have to do is to put control measures in place so that even if the risks occur, those controls can mitigate the effects of the risk. That is why, can you mute your mic? Can you mute your mic? That is why audit risks has been divided into 3 parts. Audit risks has been divided into 3 parts. We have an inherent risk, we have control risks, and we have detection risks. So you can see it here. The moment we mention audit risks, then we are simply saying that the financial statement that you have prepared, risks of material misstatement, risks of material misstatement. It means that the financial statement that we have prepared have the tendency to be materially misstated because of audit risks. Because of audit risks. All that the auditor will have to do is to perform audit procedures to assess the risk of material misstatement and seeks to limit the effects of those risks by detecting them. In fact, I must put on record that it is not the responsibility of the auditor to detect fraud and error. It is not the responsibility of the auditor to detect fraud and error. It is the responsibility of management to put control measures in place so that fraud, errors, and risks may not occur. All that the auditor will come to do is to assess whether the financial statements have some risk of material misstatement, and that will inform the type of opinion that the auditor will give at the end of the audit process. So you see that I'll put the components of audit risk here. We have inherent risk, we have control risks, and we have detection risks. Now, I've told you that the inherent risk, yes.
Sir, please,
Yes,
I have a question.
ask your question.
Yes, this is Samuel Mriku Ekwamwa, Lutheran.
Okay.
Please, you said it is not the responsibility of the auditor to detect fraud.
Yes.
But if the auditor is not able to detect fraud within statements, then would the auditing be effective?
Now, what you have to understand is that the auditor is not coming to examine or to detect the fraud. I have told you that it is the responsibility of management to put control measures in place so that these fraud, errors, and misstatements will not occur. If management fails to do that, all that the auditor will do is to examine the information that you are giving to the auditor. And in the course of examining the information that you are giving to the auditor may come across some of such infractions and may have to report on them. Auditors are not going there to detect fraud. No, that is not the work of the auditors. Never. Are you okay? Hello, are you there?
Yes, sir.
Very
Yes, sir,
good.
I'm here. Thank you, sir.
I think I have it somewhere. Let me see.
Yes, sir. Yes, sir. Yes, sir.
Let me see. I want you to see. Okay, maybe I'll meet it as we go forward. So we have control risks, we have inherent risk, and we have the detection risks. Now, if the inherent risk is associated with the business, that it becomes very difficult to eliminate. All that management will do is to control it so that its effect will be minimized. And that is what is meant by the control risk. So if the control mechanisms that management has put in place was not able to eliminate the risk, then the risk is existing and it needs to be detected and corrected so that it will not reoccur in the future. That is why at times management will put measures in place if some fraud, error, or risk occur. All that management will do is to put measures in place to forestall its occurrence in the future. To forestall its occurrence in the future. I've said several times that the auditor will have to come and examine the financial statements. Since you are accounting student, now the financial statement I am talking about are the statement of cash flows, statement of financial position, statement of changes in equity, statement of profit or loss and other comprehensive income, statement of the additional notes. Yeah, there are about 5 major reports or 5 major financial statements that the auditor will have to examine. So when we say financial statements, we are talking about the financial information which has been presented in a structured form to convey information to the users of that financial information. Now look at this slide very well. Responsibility for the financial statements. Who is to prepare the financial statement? Literature is saying that while the auditor is responsible for forming and expressing an opinion on the financial statements, the responsibility for the preparation and presentation of the financial statement in accordance with the applicable financial reporting framework is that of management of the entity. So it is never the responsibility of auditors to prepare financial statements. They come in after the financial statement has been prepared to examine the financial statement and form opinion as to whether in the preparation of the financial statement, the applicable financial reporting framework has been complied with by management, and that the underlying records portray true and fair the state of affairs of the entity. Management is responsible for identifying the financial reporting framework. This is not what I want. This is the same thing that I've said. There's something that I want. So this is our management's responsibility, which you know, they design and implement and maintain the internal control. I've mentioned the internal control system. It is the responsibility. One of the responsibilities of management is to design, implement, and monitor the internal control systems. Now that we have started internal review, you will do internal control as a topic. So you'll get to know what is meant by internal control by employing the COSO model. Employing the COSO model. COSO means Committee of Sponsoring Organization. They have a model explaining internal controls. So we shall look at that one. So management's responsibility is to design, implement, and maintain internal control systems in organization. They have to select and apply appropriate accounting policies, making accounting estimates that are reasonable. So these are some of the responsibilities of management. I don't need to read everything to you. I give you explanations, and then you try to figure out. Don't go and chew them. Don't go and chew. Learn them. You don't chew and go and write exams and forget. Don't do that. Okay. Determining the acceptability of the financial reporting. It is only the auditor. It is only the auditor that can determine whether the financial statement that management has prepared can be acceptable or not, what can be accepted or not accepted. Why? Because the auditor is the person who is going to examine the records and transactions, accounts, everything that deals with the organization, which management has put together to prepare the financial statement. It is the auditor who is going to examine that financial statement. So it is only the auditor who can tell us whether the financial reporting framework has been complied with by management in the preparation of such financial statements. So the auditor determines whether the financial reporting framework adopted by management is acceptable in view of the nature of the entity. And then here, the auditor expresses an opinion after examining the financial statement. And where the auditor is going to express an opinion, they should refer to ISA number 700. That is Independent Auditor's Report. The Independent Auditor's Report can be found in the International Standards of Auditing, number 700. That will give the structure and the content of the report that the auditor will have to give. So there's a format for the report, and ISA 700 is very instructive on how the report is to be written and delivered to the shareholders. Types of audit. Principally, we have statutory audit, then we have private audit. Statutory audit, that is every company that is a limited liability company are enjoined by law to have their accounts audited at the end of the period. So if you audit your financial statement because the law says your financial statement is to be audited, then it becomes a statutory audit. It becomes a statutory audit, a requirement that you have to have your financial statement audited. Then that is meant as statutory audit. So a statutory audit arises under the Companies Act, as a result of which it is a statutory obligation for the accounts of every limited liability company to be audited annually by a professional qualified auditor. So if it's a requirement under the Companies Act that limited liability companies should have their accounts audited, then that audit which is being carried out is a statutory audit. It's a statutory audit. Apart from this, if we have a sole proprietorship, and they want their account to be audited, that cannot be a statutory audit, because sole proprietorship businesses are not enjoined by law to have their accounts audited. And they may decide that to be able to secure maybe a loan from the bank or for any other purpose, they want to have their accounts audited. That one is a private audit. A private audit. So a private audit is one undertaken at the instance of the interested party. Example, a sole trader or partnership. There's no law that enjoins partnerships and sole trader to have their accounts audited. So there's no legal obligation for them. So if they decide to have their accounts audited, then that can be classified as a private audit. Apart from classifying audit as statutory and private, you can also say external audits and internal audit. And the auditing that we are doing now is external audit, because it is some independent person out of the organization that will come to examine the financial statements. So external audit is where independent persons are brought in from outside an organization to review the accounts prepared by management, which is in contrast with internal audit, where the organization itself will appoint a full-time staff to monitor and report on their activities. So internal audit or auditors are employees, whilst external auditors are not employees. We can also have complete audits. Complete audits. Now, when you say a complete audit, normally happens where we have small businesses. They can start and complete the audit within a year. So you start and complete the audit as soon as the accounting year ends. Then everything is done and gone. That is what is called a complete audit. So this complete audit normally applies to smaller businesses where the volume of transactions and the complexities of the records are not much. So the auditor can even come once in a year. At the moment they come, they'll be able to finish all the work and go back. Unlike where you can have what we call a continuous audit, where the volume of transactions are many and the complexity of the records are also present. That will not allow 1 year visit, or sorry, 1 time visit to be able to finish the audit work. Then we also have interim. Interim means before the final. So where we have a very large businesses, the auditors may not necessarily wait to the end of the year before they go in and do the audit. So maybe after 3 months, 6 months, the auditor will go and examine the records up to that date. So by the time the year gets to an end, they'll be able to finish the audit work. So that's why at times they can issue an interim report. The interim report may cover maybe the first 6 months. That may not be the final. The final report may be issued where the auditor has completed the audit, where the auditor has fully completed the audit. So this interim audit can be done every 6 months. So we call it biannual, twice a year. That's every 6 months. It can be done quarterly or even monthly, depending on the volume of audit work that is considered necessary. So that is called interim audit. Then, as I did mention earlier, we have a continuous audit. And that one happens where the company is very large and there's a fundamental weakness in control systems. So always the auditors will have to be on their neck so that they'll be able to do the right thing. That is what is called the continuous audit. You can appraise yourselves with some of these things. I think some of them are in your model. I understand you have models. Is that right?
Yes, sir.
Yes, sir. Yes, sir.
Very good. So where we have reached is the objectives of auditing. Why do we audit? To detect errors and fraud, to prevent errors and fraud, to help client to improve his accounting and internal
Some
control
of us
system.
are not having the, some of us are not having the models.
Why? What happened?
I don't know where they have gotten there.
There's a
It's a
link.
soft copy.
There's a link you have to download. Oh, is that not true?
Yes,
Yeah.
sir. It's a link that we have to download.
Yes,
You
sir.
guys will give us
Nobody is having a hard copy.
Some of you
You
have
have
hard
the soft
copies.
copy, sir.
Yeah, some have hard copies. So you should have it. The last time I asked you to create a WhatsApp platform for the course reps and add me, you didn't do it. I would have put the link there for you to download.
Have you done that? On that, it's like we were having misinterpretation. They were saying all the class should create the group, but we were saying it was class reps. So
I didn't say all the class.
After yes.
I did not say all the class. I say class reps. Class reps should create the
so
group
you
and add me.
After the class, we will finalize.
So that I can put some of this information there for you. Are you okay? Don't add me to your main group.
We'll do that.
So many things go in there in your main group. So don't add me there. Just course reps only.
Okay.
So this ones, I will not be taking advantages of audit. Now, this one, level 400, even in campus, I don't teach all these things. We are spoon feeding you. I'm the same person who is teaching audit and internal review at the level 400 in regular UCC. So it is the same thing that I'm teaching you. So what I will not teach there, you two I will not teach. You are all getting the same certificate. So why should I be going line by line here? Why I didn't teach them line by line? So you should also help yourselves. So the advantages, limitations, and the rest.
Time is limited.
Your time is limited, eh? Your time is limited. It is well. Don't worry, you'll be fine. Are you okay? Hello?
Yes,
Are you
please.
there?
Yes, please. Yes, please.
Yes,
Yeah, there, sir.
There's no cause
Yes,
for alarm.
yes.
There's no cause for alarm. Are you okay?
Hello,
Okay.
Doc.
Yes, sir, we are. Yes.
Yes. You are in safe
Hello,
hands.
Doc.
So
I have a question.
yes, ask your question.
And so you mentioned that the Act 992 entreats limited liability companies to undertake audits
Yes.
and hence make it a statutory audit. But I want to ask, how about, for instance, the sole proprietors and the unlimited liabilities companies that also prepare financial statements and undertake audits for those statements for purpose of tax and other regulatory bodies standards? Would we turn those audits to as statutory, or we are
No,
only
it
looking
cannot. It cannot be statutory. It cannot be statutory. It cannot be statutory. It is a private audit. It cannot. When you say statutory, it means you are backed by law to have your accounts audited. That's what we call statutory. Are you okay?
I'm okay. However, the Income Tax Act stipulates what terms filing your returns should meet. That is the requirement.
I didn't say that. Didn't say have your accounts audited. Never. They didn't say that. They didn't. You can employ an accountant to prepare your financial statement and file your returns. They didn't say have your accounts audited. They didn't.
Okay.
It is not stated in the act. Never.
Okay.
Very good. So you arm yourself with advantages and limitations. Now we have something we call the expectations gap. Now, when you say expectation gap, all that we are saying is that what the general public think that is the auditor's work is different from what actually the auditors do. So what the general public expects from the auditors is not what the auditors also do. So there's a gap between what they expect and what is the actual work of the auditor. That is what we term as expectations gap. So like what we said earlier, that auditors, people think that when you say an auditor, then he's coming in to detect fraud. No, that is what we think. But that is not the actual work of the auditor. So there's a gap of understanding what actually auditors do. That misconception is what we term as the expectation gap. So if you read my fourth bullet, the fourth bullet says there is the misconception that it is the auditor's duty to detect fraud, when in fact the detection of fraud is the responsibility of directors. Have you seen that one? Did you see that point?
Yes.
Aha.
Yes.
So that is a misconception. We think that auditor's duty is to detect fraud, but that is not the work of the auditor. So there's a gap from understanding what actually the auditors do. So any misconception about the role of the auditor is what is termed as the expectations gap. Expectations gap. Okay. These ones, I don't know how to go about this one. They are nothing. We haven't even seen questions on this before. But you can read. It's about 6 or 7 stages. It doesn't matter. What matters is you can read at your own time. About, well, let me see how many stages. 5. But this one matters. Audit committee matters. Always your end of semester question, there's a question on audit committee and corporate governance. So audit committee matters that you need to know. Now, there was scandal in the United States of America where auditors audited some companies, certified that the companies have clean records. But in the course of the year, things happened, and it was detected that indeed such companies' activities were not in line with what the auditors actually said. So it was agreed that companies should at all times have what we call audit committee who will serve as a link between the external auditors and the business or the company, so that if the auditors raise any concerns about the company, it is directed to the audit committee, and they will have the honors of responding to the management letters that auditors write to the entities. So because of these scandals that happened in the United States of America, they commissioned a committee to examine those scandals. And one of such committees was Cadbury. So the chairman of the committee, they used the chairman's name. So Cadbury's committee's report. There was another committee which was called Sarbanes-Oxley's committee report. All these reports have in there that modern companies should appoint audit committees who will create a space between the external auditors and the directors of the client company. Because at first, when auditors audit the financial statements and they raise queries by way of writing management letters, there's no one within the company to respond. So if this audit committee is there, they will serve as a link between the company and the external auditors. So the Cadbury committee report recommended that financial reporting should incorporate the responsibilities of management and the responsibilities of auditors, so that at any point in time, if something goes wrong, we will know where to situate the problem, either on the doorstep of management or on the doorstep of the external auditors. Through that, many companies nowadays have audit committee in place. And these audit committees are mainly non-executive officers of the company. And they look at the activities of the company dispassionately, so that they will be able to advise the board on things that are not going on well with the company. Because if you are an executive officer, you are part of management. So if something is not going well, you can't even say it. But the Audit Committee report recommended that membership of an audit committee should mainly be non-executive officers, so that they can pinpoint infractions as and when they occur within the organization. And these are the functions of the audit committee. They review financial results that are shown by both management accounts and the financial accounts. When I say the financial accounts, that is accounts that are normally presented to the shareholders. Management accounts is used within the organization. It is the responsibility of the audit committee to review formally and regularly the financial results as shown by both management accounts and those accounts that are presented to the shareholders, to recommend improvement in the management control systems, and to ensure that there are adequate procedures for reviewing rights circulars, interim statements, forecast, and other financial information. So the audit committee serves as, if you want to say, like a pressure group that are there to make sure that proper things are done within the organization. So these are some of the functions of the audit committee. They are about 10. Is that 10? Let me see. 1, 2, 3, 4, 5, 6, 7, 8, 9. Please note it well. Note it well. It is very important. Note it well. Note it well. Lastly, we shall look at the agency theory of and auditing. Agency theory and auditing. Agency theory and auditing. Now, every organization is seen as having a relationship between management and those who provided the funds, which you call the shareholders. Since the shareholders provided the money, management is acting for and on behalf of the shareholders. So the shareholders can be described as principals, and management can be described as agents. So at any point in time, there is a relationship that occurs between the agents and the principals. Since the principals provided the money for the agent to run the business, the agent must always cater for the needs of the principal to make sure that the principals have enough returns on their investment. On the other hand, when the agents, and for that matter management, increases their pay, it means that they are going to limit the amount of money that is going to be available for the shareholders. Because when they increase their pay, the profit of the business will go down. And the profit of the business is the one that is going to be distributed by way of dividend to the shareholders. So there's always a conflict between the agent and the principal as to whether the agents have to satisfy the principal at their own detriment or satisfy themselves at the detriment of the principal. And that is why there's always a conflict in that agency relationship. If the agents want their welfare, it will go against the principals. If the agents look at the welfare of the principals, it will also go go against the agents. So there is a dilemma in that relationship between the agent and the principal, and that creates a conflict amongst them. That is what is termed as agency relationship conflict. That is the agency problem. I have been able, so you see, almost done with that. I have been able to go through all that we have in Unit 1. It's not a small task. It's about 57 slides that I prepared for Unit 1. And I'm happy that I have been able to go through all for you. The one you see on your screen, the regulatory framework of auditing, is in Unit 2 that we are going to do this weekend. I entreat you to read ahead before you come. Those in Lutheran Medina, this weekend I'll be available. I'll come on Saturday 7 to 9. And those online, I'll meet you Sunday 9:30 to 11:30. I thank you very much. In fact, your attendance this evening have been very impressive. You joined massively. Let me see the total number of people who have joined. About 53. Yeah, about 53 people have joined. Just keep on like this, and I hope we will all enjoy. Mabel, ask your question. Mabel, ask your question.
Sorry, sir. Mabel is the man.
Oh, how can Mabel be man? Okay, so man, ask your question.
Yes, sir. It seems my question had already been asked, but I forgot to put down my hand.
Okay. So. Okay, all right. So I hope you have enjoyed the lecture. Two of us.
Oh yes, we have.
True.
Very good. All right. So we'll meet weekend.
Thank you very much.
Have a good night. Yes, have a good night.
You too. Bye.
Okay, sir.
Bye.
Sir.
Yes, please.
Hello, sir. Please concern the
Yes.
group creation.
Yeah.
Concern the group creation. It was, in fact, it was intense last weekend. We were supposed to create
for the presentation.
Group. No, group for the class reps. But they were saying it's supposed to be general. So I want you to clarify.
No, I say class reps. So please do that for me and add me. Are you okay?
Okay, sir.
Are you okay, please? Oh, okay, very good. Very good. Thank you.
Please, all class reps should stay behind. Let's do this.
Okay.
Please, who is the class rep?
I am.
I beg, give me your number.
Yeah, 0243 419.
Your network
0243
0
243
0241
No,
0243.
Yeah.
0243, right?
419. Yes, please.
419. Okay.
683.
683.
Yeah, Richard.
Mensah.
Please, you are class rep from where?
Lutheran. Medina.
Okay. Medina.
Richard Medina, right?
Yeah.
Please take mine. STU.
Please, are they coming?
Okay.
STU.
0542.
0543.
0542.
0542.
Yeah, 435.
435.
932.
932. Bernard.
Bernard. Yes.
Which center? Bernard, I beg, which center? STU.
STU, yes, STU.
Okay. I beg, Ruby. Ebenezer. Okay, your number. Ebenezer, your number.
0595.
0595
55
55
18
18
89.
89.
Please, which center? Ebenezer.
Yes, man.
Where's Max?
Max not the course repo.
I know. You know Joanne.
I've not seen him.
Oh, okay.
Hello.
Yo, senior.
Yeah, also.
Class rep, right?
Is that?
You be the class rep, right? For accounting.
Hello, guys.
Yeah, this
Good evening,
accounting.
guys. Yes.
Hello.
Yeah.
Hi. Good evening.
NS.
Yes.
Yeah. Good evening. No.
Good evening.
Please, how are you?
Adeo, my guy. Alfred.
This Alfred.
What did you do for you?
What are you doing for you? I can't go. Answer me for
minute.
you. You know what call me, sir. I
Yeah,
can't
a
be
minute.
I will call you. I will call you.
Okay.
Yeah.
But you.
Richard.
Hello, a minute.
Victor, the link in the mommy.
Hello.
Bye. I will call you.
I hear, senior. Okay.
Hello.
Yeah.
Richard.
Could you watch it?
Yeah,
Yeah, hello.
we are recording.
Did the lecturer join? Did he
No,
join the
he has
meeting?
left.
He has left.
He has
What?
left.
So no lecture today, right?
Richard,
We just
I'm
finished the
asking you a
lecture.
question.
Yeah, yes.
Could you-
Yes, that was.
We just finished the lectures.
Yeah, we are
What time
done.
did we start? When did we start?
7.
It was around 7 o'clock, yes.
But he didn't give
Yeah.
time for us to join. What kind of life is that? We are paying for this.
Champion.
Yeah.
Yeah.
Richard,
Martina. Yeah.
please,
Could
did
you
you guys
say-
record the? Did you guys
Constantine,
record? Sorry.
Oh,
Guys,
boys.
did you record?
Oh, no.
Oh.
NS, please, lecture was sharing a slide, no.
Ernest,
Not yet.
Page living on tour.
Ernest,
Yes.
create the
Yes.
for us.
You see?
Please create the group for us.
Yeah, that's
We can
what
get
they
some-
create. That's what they do. That's what they will do.
Okay.
Yeah.
Okay.
I mean,
NS add you. Add the men means me add in the class.
So as an
Ernest.
class, so please group we know just for the class rep and the
This one
lecturer.
for only class reps.
Yeah, but
Uh-huh.
I'm also a course rep.
So you don't need to add your class.
Okay,
That's
so only
what I
the
want to
course
clarify
rep.
to you.
Oh, okay.
Right now, it's
Yes.
only
Yes.
3 numbers that I've
Okay.
received. Only 3 numbers.
So you just create
And
it,
you
add
have
them
my
as and
number,
when
so you add my
they
number.
give it.
You Alfred who on put the back house meeting to wait, Alfred,
Martin.
I will call you.
Ernest,
Right now, it's only
Okay.
Richard, Bernard, and Ebenezer Fiasman. I have
you create the group.
Or make a
add them
create
as
the
and
next.
when, the number.
Okay, I hear.
You create the group. Yes.
Okay, sure.
Okay.
Are they add
So-
12 join purple?
So you see you next time.
Okay, sir.
I hope that's all, senior.
Yes, I've taken the numbers, so that's all.
All right.
Because so far I've received three sentences so far.
Okay, that's Madina.
STU and Fiasman.
And okay, that's great.
So